If you've ever sat down with a financial advisor or watched a YouTube video like this one and heard the words guaranteed income, I'd bet the very next thought in your head was, okay, but does that mean my money is locked away? It's the number one objection I hear. Retirees want the safety of guaranteed income, but they're terrified of losing access to their own money. Here's the truth. For a lot of retirees, that's a false choice. You don't have to pick one or the other. And today, I'm going to show you exactly how that works. We'll go over the mechanics so you can decide for yourself if it makes sense for your situation. Let's start with the two options most retirees think they're stuck choosing between. Option 1. Keep everything liquid. Keep it in the market, in savings, wherever, fully accessible anytime you want it. The problem? You're exposed. If the market drops significantly in the first few years of your retirement, something called sequence of returns risk, that can permanently damage how long your money lasts. There's no guaranteed paycheck. Just hope that the market cooperates. Option 2. Annuitize everything. Hand over a lump sum, and in exchange, you get a guaranteed income stream for life. Sounds great until you realize that lump sum is essentially gone. You've traded control of that money for a promise of payments. If you need $20,000 for a new roof or a medical bill, that option often isn't there anymore. So here's the real fear underneath all of this, and I want to say it plainly because it's a completely legitimate concern. What if I need a chunk of cash, an emergency, a home repair, a health scare, and it's all locked away where I can't touch it? That fear keeps a lot of retirees from ever exploring guaranteed income options at all. And honestly, if those were truly the only two choices, I'd understand the hesitation. But they're not. Let's clear up some confusion because I think this is where most of the fear comes from. People are using the word locked to describe two very different things. Thing number one, a surrender charge period. This is temporary. It's a declining schedule, usually shrinking each year, that applies if you withdraw more than the allowed amount in a given year. It's not permanent. It's not, you can never touch this money. It's a structure that discourages pulling out everything at once, similar in spirit to an early withdrawal penalty on a CD or a retirement account. Thing number two, full annuitization. This is different. This is when you convert your entire lump sum into a stream of payments, and in exchange, you generally give up direct access to that lump sum going forward. Here's the important part. With many fixed indexed annuities, or FIAs, today, you're not required to fully annuitize. You can use what's called an income rider, which lets you turn on a guaranteed paycheck while your account value, your actual money, is often still sitting there, still yours, still potentially accessible under the contract's terms. I want to be careful here because this varies a lot by carrier and by contract. Not every fixed index annuity works the same way. That's exactly why reviewing the specific terms of a specific contract matters, which we'll come back to. But the big idea is this. Locked up and guaranteed income are not the same thing. You can have guaranteed income without giving up all access to your money. So, how does this actually work in practice? Let's break down the tools that create flexibility inside a guaranteed income structure. Free withdrawal provisions. Most fixed index annuities allow you to withdraw a percentage of your account each year, commonly around 10%, with no surrender charge, even while you're still in the surrender period. That means access to real cash every single year without penalty. Income riders. This is the piece that surprises people the most. An income rider lets you activate a guaranteed lifetime paycheck, money that arrives every month for the rest of your life, no matter what the market does, without annuitizing your entire contract. The remaining account value doesn't just disappear. In many cases, it's still there, still growing based on the contract's terms, and still passes to your beneficiaries if something happens to you. Death benefit. This is one of the biggest differences from full annuitization. With many FIAs, if you pass away, your remaining account value goes to your beneficiaries. With a fully annuitized contract, depending on how it's structured, that income can simply stop. That's a meaningful difference for anyone thinking about what they want to leave behind. Nursing home and terminal illness waivers. Many contracts include provisions that waive surrender charges entirely if you're diagnosed with a qualifying illness or need to enter a nursing home. In other words, the contract is often built with real life in mind, not just the good scenarios. Here's how I'd summarize it. You're not choosing between guaranteed income and access to your money. You're choosing a contract, and a well-structured one is often designed to give you meaningful amounts of both, within defined limits. I do want to flag something important. These riders and provisions typically come with costs, and the details differ significantly from one carrier to another. This isn't a universal feature of every annuity out there. It's a feature of some well-designed contracts, and part of my job is helping people figure out which ones actually fit what they need. Let me walk you through an example that reflects what I see often in my practice. I'll call her Linda. Linda was 64, about a year from retiring, and she had $150,000 sitting in savings that she considered her safety net. When I first brought up fixed index annuities, her response was immediate. I can't lock that up. What if something happens? Totally fair. So instead of an all or nothing decision, we looked at splitting the allocation. A portion of that $150,000 went into an FIA with an income rider, designed to eventually turn on a guaranteed paycheck that would supplement her Social Security for the rest of her life. The remainder stayed positioned with liquidity in mind, so she still had a cushion she could access without penalty. Fast forward. Last summer, her air conditioning unit died in the middle of July. A $6,000 repair, completely unplanned. Because of how things were structured, she had access to funds through the free withdrawal provision. No penalty, no drama, no touching her guaranteed income stream. She got her paycheck, and she got her air conditioning fixed. That's the entire point of structuring things this way instead of treating it as an all or nothing decision. Now, I'm not going to stand here and tell you this is perfect for everyone, or that there's no fine print, because there is, and you deserve to know it. Withdrawals beyond the free amount still trigger charges. If you pull out more than the allowed percentage during the surrender period, you will likely face a surrender charge on the excess. This is not unlimited access, it's structured access. Turning on an income rider is often a significant, sometimes irrevocable decision for that portion of your money. Once that lifetime paycheck is activated, you're generally not able to undo it. That's part of how the guarantee is made possible. Not every fixed index annuity is built this way. Riders, free withdrawal percentages, waivers, they vary widely by carrier and by contract. Some are more flexible, some are more restrictive. This is exactly why reading and understanding the specific contract in front of you matters so much. I say this often, and I say it again here. My job isn't to make everything sound perfect. It's to make sure you understand exactly what you're getting and what you're giving up before you sign anything. Here's what I hope you take away from this. The idea that guaranteed income and access to your money are mutually exclusive just isn't accurate for a lot of well-structured contracts. But how much should go toward guaranteed income and how much should stay liquid? That's not a one-size-fits-all answer. it depends on your specific numbers, your other assets, your health, your goals, your family situation. If you want to know more about how to plan for your retirement income, get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. Thanks for watching. If this helps clear something up for you, hit subscribe so you don't miss the next video. Because when it comes to your retirement, a little clarity goes a long way. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.